Welcome back. Buy cheap, high cash flow rentals will cost you dearly. Welcome back. So let me share the screen. And if you want to use real estate to create generational wealth, watch this first. Again, buying cheap rentals will cost you very dearly. Do this instead. So, over the years, most real estate so-called gurus, I call them fake gurus, and YouTube content creators promote these type of junk houses and hype their paper games. They are the following, but not limited to it. Fix and flips, BRRR, buy, uh, rehab, refinance, and repeat. Very, very popular. Overhyped as usual. Wholesaling, subject to, etc. Short-term rental, mid-term rental, co-living, rent by the room, pet split, door-to-door knocking, multi-units, commercial, REIT syndication, all this overhype, very, very misleading. It's just very, very misleading. That's all I have to say. Okay, here's some example of the YouTube content creators that I've come across in YouTube channels over the years, in particularly the last few years. Look at this headline. Uh, some of you know who this social media content comes from. Very, very popular website. $6,000 per month positive cash flow with only 10 rentals in just 2 years. $13,000 cash flows and quitting her W-2 job in just 1 year. Wow. Wow. $10,000 a month, monthly net cash flow. What they failed to tell you, they failed to incorporate all the debts, the mortgages they have to pay on the rentals, vacancy factors, maintenance, upkeep over the long term. But I'll discuss that. I will cover those areas in detail. But they overhype everything. They create this huge, huge cash flow. There's a reason for that, okay? I've been around for more than 20 years in real estate investing, okay, in many markets over the years, and I have helped hundreds of my students, and I mentor so many investors over decades. So I've been there, done that. I went to the school of hard knocks. So I know those different markets. I know the strategies. I watched the YouTube contents over the years, and they are just absolutely overhyped to the nth degree. Nth degree. Okay, let's continue. 32 units in 5 years. How are they? How they scale? What type of units are they buying? What kind of high cash flow? These days, as we're moving into 2025, there are virtually very few, if any, cash flow properties in the country, let alone high cash flows, except in this market. I'll give it away a little bit, the Midwest region, but I'll discuss it in more detail. All right, 35 units while working full time, $8,000 monthly cash flow. What they fail to disclose is how they quantify, how they calculate cash flow. A lot of these content creators, a lot of these testimonials, where they interview their investors, they fail to disclose the reality. They fail to document the proper debt service, the mortgages, the taxes, the insurance, the maintenance fee, the upkeep, and the vacancies, the whole 9 yards. They just talk about the gross rent most of the time. They don't want to disclose all the expenses, okay, which will pile up if you buy in a wrong market, if you buy the wrong type of properties, okay, especially older properties. They don't talk about that, but I will. I'm gonna dive deeper. I mean, I am going to disclose and what's that word? Uh, just call out these people. Call, I forgot that word. Anyway, let's continue. quitting his W-2 job with only 5 rentals. Oh, really? You think it's that easy? You buy 5 rentals, have $5,000 monthly net as a gross cash flow or net cash flow before debt service and expenses. I want to know about that. I wanted them to to show accountability, to show transparency. They failed to show transparency. All these YouTubers, when they interview these testimonial investors. Look at this young kid. This young kid. I'm 21-year-old and I bought 100 doors and I'm retired within 1 year. Yeah, 100 doors. What do you mean by 100 doors? Are you in syndication? You buy fractional shares? Do you own all the 100 doors? How do you define doors? Okay, that is where the lack of transparency comes in. Okay, all these fake YouTube videos is just mind-boggling. It just create a lot of confusion and chaos in the real estate education world, YouTube world. Okay, let's continue. Quitting his W-2 job with only 6 rentals, 6 rentals producing $8,000 cash flow per month. Wow, too good to be true, and it is too good to be true. And then they use their strategies. Find distressed sellers, make disrespectful offers, yada yada dee dee da da doo 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 doo. Most real estate investors, especially rookies, buy these types of old houses in this market. Where is this market? Midwest and Northeast. Look, let me get this clear. A lot of people have success buying older properties, cheaper properties with cash flow in the Midwest. I'm not saying every property is wrong. All the old houses in the Midwest and Northeast, 50 to 100-year-old houses are bad. Okay, I always experience success stories. Even some of my students have achieved success buying in this type of market, the Midwest market, if you will, right? Older properties with high cash flow. I get it. But more often than not, the way these type of properties are being pitched to the general public by these so-called fake gurus, they are overhyped. They're overpromise and under-deliver. I know who they are. I know the players in the game. I know who are the fake gurus and who are not. Okay, I'm not going to mention those names. And okay, if you do enough research, you will find the pretenders, okay, and the suspects and the fake gurus out there. Okay, I digress. Let's continue. The reason why a lot of these content creators they invite these testimonials of young investors achieving massive success, massive cash flow by tons of doors because they're buying this type of markets. Okay, with these old houses. Look at this. Look at some of this example. Look, this property, $34,000 in West Virginia somewhere, built in 1898, whatever. I don't know, in 1920, whatever. Okay, I'm not saying they're bad. There are many older homes that have done very, very well, but there's more hype in the YouTube world they're promoting this kind of properties over the years than I care to acknowledge. Okay, so anyway, let's continue. Look in Ohio, nothing against Ohio, but look, some of this $67,500. Yeah, fixer upper BRRR BRRRR strategies and fix and flip. These are typical properties where the gurus or so-called out there they try to promote and they charge their students, unsuspecting beginners out there, charge them $20,000 coaching fee and make their students do all kind of work and just by charging a coaching program at the end of the day, the students they have no money left over to buy a real property after they pay these overpriced coaching programs. Okay, anyway, and they promote this type of property. Okay, $71,000. Oh, look at the rental value ratio is 1.4%. Way the capitalization rate 9.2%. All these nice paper numbers, high returns, whatever, right? and $71,000 property, they rent for 1,000. So, it's a very good ratio, but on paper, that's what's happening. But what you fail to realize, if someone would underwrite the deal, do the due diligence, this is not a good deal after all. Because why? I'll explain later, but okay, taxes, you have to pay. You have to incorporate, you put 25% down payment, I get it. Then you whatever, you pay your taxes, your insurance, maybe property management fee more often than not. Then you have to pay the maintenance and upkeep and the vacancies. Look, the vacancy is at least 8%, right? Management fee maybe 10%. Maintenance percentage, upkeep and maintenance is 10%, right? When you incorporate all this debt service, all these expenses, at the end of the day, to buy such a nice, numerical ratios, you put 21 grand down payment, right? Even the rent is so high. At the end of the day, based on all this debt service and expenses, your monthly net cash flow is a mere $172, and with very, very little appreciation on the as an icing on a cake, because that's how it is, right? When you buy in a market where there's a very little appreciation, of course, based on inflation alone, that's why the cash flow on paper is, seems to be high. But when you dig deeper, when you do more research, all this paper hype are not, are not what they cut out to be. So the way I look at it, I look at this typical look, those Midwest properties. I hate to pick on Midwest. I mean, you have to look at, I subdivide the property in terms of A class, B class, C class, right? A class or the best neighborhood, probably a higher price. The cash flow is not as high. A class, I wouldn't buy an A class. It's too expensive. You cannot cash flow, right? But again, it depends on location. B class is the one I would buy. B to B plus class, good neighborhood, right? Good tenant and growth markets. And C class, and C and D class I stay away from because they are in the ghetto. They are in the hoods, right? They are rough neighborhoods. So I look at these metrics, right? Maintenance 8% on A class in any given year. B class 10%, C class 13%, D class. I might as well expand the class category even further. In a rough neighborhood, maybe 15 to 20% maintenance and vacancy, right? Okay, that's a 1 to 4 unit, single family home to four units, which I like. This category, I like this category. But some of these overhyped gurus and YouTube content, they talk about multi units, 5 units and above. The A class is fine on this multi units, but B and C class, look at this maintenance and vacancies and upkeep. It'll destroy your cash flow, and giving that the appreciation itself is not going to be that high because these kind of neighborhoods are not growth markets, right? Appreciation is very, very low on a historical basis. There are some exceptions, okay? I mean, there's always exceptions. Certain Midwest market is pretty nice, like, up and coming, like Columbus, Ohio, and Indianapolis, Indiana, and just to name in Buffalo, New York, in Rochester, New York, some of this Midwest low cost market, older homes have high cash flow, and they're pretty stable market. In a lot of investors do invest in Midwest markets, but don't get me wrong, okay? I'm not trashing every single neighborhood in the Midwest and Northeast. But having said that, the big picture is buying this older kind of properties, and achieve long-term wealth. It's just not sustainable, okay? If the foundation is just not right based on this picture. It's just because, at some point in time, when you buy these kind of properties, you're gonna experience crash and burnt, right? You're buying junk, you're buying garbage. I hate to be so, direct and so blunt, but I want you really, really need to take a step back to really know the consequences and making this kind of investment decisions, right? It'll cost you an arm and a leg and several other body parts that I do not care to get into, okay? So, having said that, instead, you should buy in this type of market, okay? Buy long distance, buy remote, buy turnkey new builds, cash flow rentals in the best markets in the country. One of them is, Dallas, Fort Worth, which is, we have those opportunities. Of course, we're not going to buy $1 million homes for investments because the numbers just doesn't make sense. But that's what you want. You want to buy in a growth market. They have a lot of high-end homes, but there are entry-level homes available for you to buy to cash flow, which I will talk about. Some of the highlights I would like to discuss, is in North Texas, Sherman, Denison, Bonham, and Greenville. So this are one of my favorite markets, and I'm not going to go over these numbers, but in the past 4 years, these small boom towns in North Texas are growing by leaps and bounds based on these metrics. As you can see, appreciation, median price growth in the past 4 years, so forth so on. And one particular area is Sherman, Texas, which is a semiconductor high-tech hub of the South of the country. They call themselves Silicon Alley or Silicon Prairie or the new Silicon Valley. All right, so again, you buy in the North Texas county of Grayson, Collin, and Hunt County, where the median price home is relatively low. So you can buy entry-level homes, affordable homes, and put a tenant in there for cash flow and appreciation, strong appreciation potential. You buy in a rural, boom towns, small cities. That's the future of growth. I'm not going to discuss too much, or I got too many slideshows, but it's a big picture. I have done other videos in this market. So let's take a quick rundown of some of these criteria that investor will look for. And here they are. You could pause the screenshot to digest this criteria, which I put together on my slideshow. Okay, here they are. Okay, so again, we have builders we work with. These are off markets properties, new construction, below value properties. We have relationship with national and local builders in the North Texas that will supply this off-market inventory for select investors within our network. We have amazing builder incentives, as you can see, with 30-year fixed rate mortgage of 5.75%. The builder will buy down the rate for you so you can achieve higher cash flow than normal. Being a new build, you have builder warranties. The builder will pay 2% of your closing costs. The first year free property management, the whole 9 yards. Amazing builder incentives, and these are the typical properties that we promote in a great A-class area. A-class tenant, A-class locations, growth market in a path of growth, low entry level in the low 200K, right? With good cash flow, good rent, the whole 9 yards. All right. So we have and also all the small city boom towns located all over North Texas. This is a sample of market opportunities we have available. All these numbers are very, very attractive. Cash flow, everything. Okay. So yep. Everything's in low 200K, which is, you're not going to see these kind of prices ever again moving forward. Look at this brand new duplex for only $355K at 25 to 30% down payment. You have almost $800 a monthly cash flow. Plus, the vacancy is very, very low factors, and the maintenance is almost non-existent because it's a new construction, the whole 9 yards. Okay. So again, the 2 to 6 year hold strategy. This is our concept. You buy this growth market, you're able to cash out, refinance, and do a 1031 exchange in 2 to 6 years at a time. So amazing leveraging and scale your portfolio. If you buy in a right market, buy in a growth market, that cash flow initially, that will give you tremendous equity growth so you can scale your portfolio, buy all these entry-level homes over time. Diversify in different boom towns, not just in Texas. You can diversify whatever market you want to. So, okay, all this, you build your rental empire one property at a time, based on your goals and objectives and your capital resources you have available. But at the end of the day, right, when you buy new construction, it'll last you a long time. It'll last you multi-generational, right? You can pass on to your loved ones instead of buying the junk properties after a few years of maintenance and upkeep, and and whatever, and you can get so tired. It's a brain damage. You buy older properties at the beginning, you might get some very good deals below market, whatever. But once you experience the stress of vacancy, of this, of the buying in the bad locations, bad markets, then you're gonna quit. You're gonna, your portfolio is not gonna last long. Okay, so that's how you build your empire. One property at a time. You can scale unlimited. You don't have to buy 100 properties. I mean, some people have the motivation to do that, but when you buy new constructions, all you need on the average around 3 to 5 high quality new construction properties, 1 to 4 unit, you just, and, hold it for 10 to 15, 20 years. You'll be fine. 3 to 5 properties, maybe 10. Okay. So, just, do whatever you feel comfortable, right? And so, okay, so in the end, by being it is a turnkey property, have professional property management, regardless of where you live, all you do is spend 1 to 2 hours per month in managing your portfolio. That's it, right? Because we have a team on the ground that will do all the things for you. They'll pick the property. It's off market. If you're part of our network, you have opportunity to buy these properties, assuming you qualify, right? So buying turnkey properties in the way I just explained to you, you don't need a second job to manage your portfolio, right? This approach that we're using allow you to reclaim your time and energy to focus on what matters most to you. Okay, that's the whole key. So you buy for long-term, buy and hold, right? And don't worry about the short-term volatility. You're going to collect rent because you are buying in good areas, good growth market. Like as I described to you, you have a very stable tenant. You can collect cash flow. You can let the tenant to pay down your mortgage and everything else for you, right? That's the whole key. You buy early in a growth market and just sit tight and let everything work out for you. So, okay, most people are fearful. You need to be greedy, and this is what's happening in today's market per Warren Buffett. Okay. Again, your 3 options are do nothing, stay in financial mediocrity, do something on your own. It may take weeks, years, decades, and never buy anything due to analysis paralysis, right? Or the best option is work with us. So contact me for 15-minute complimentary consultation. If there's a right fit, if you are the kind of investor that can benefit from working with us long term, you have the right attitude, right commitment, the right mindset, and everything else. We like those kind of investors. All right, so here's my contact information. So at the end of the day, that's what's all about, right? Be careful where you buy. That's the most important key. Surround yourself with a trusted team on the ground. We have great team on the ground wherever you mine through our network, because we have vetted all those places. We have a great track record. Our property management on the ground have done a great job for years. They have managed thousands of rentals over the years, and they have done a good job. So anyway, that's all I have to say. Thank you so much for watching. So at the end of the day, to recap, if you want generational wealth, you buy new constructions because they last a long time. They are a good location. The tenant going to stay very long. You have a very little maintenance issues because they're brand new. They have warranties. You can have a lot less stress. You can be very, very peaceful knowing when you're sleeping at night, money grows on trees, very little stress, and the whole 9 yards. Okay. Don't buy this old dilapidated properties in those bad markets and bad locations. Okay. So hope this video will find you well. Thank you so much for watching. I'll see you next time. Have a nice day. Bye-bye.